Welcome back to the Innovator Spotlight Series. Today we are exploring how African-centric investments are redefining startup funding. Our guest today is going to be the Vice President at Vested World, a firm prioritizing societal impact and gender equity. With personal values in empathy, humility, and resilience, he will discuss how they are operationalizing these values, how they are spotting intangible resilience in founders, and Vested World's unique position between traditional VC and private equity. So please help me welcome my guest today, Peter Wamburu. Welcome, Peter.
Thank you, Ammishaddai. It's a pleasure to be here. Thank you for having me, and thank you for the very warm introduction.
Absolute pleasure, Peter, and thank you for joining us. Our theme today is our theme for today's episode is going to be about the intentional investor, how you are blending returns, resilience, and also responsibility. And Vested World is, from what we have gathered, an early stage investment fund. That's not quite VC, it's also not quite private equity. How do you, Peter, personally define that sweet spot? And why is investing in bankable companies that don't fit the traditional VC mold, especially here in Africa, the most sensible approach for generating both competitive returns and essentially impacting African markets?
No, thank you. That's a great starting question. I think the way we typically describe Vested is that we are an early stage fund manager, and we focus on essential products and services for African consumers. We view this across three main thematic areas that we believe are fundamental to economic development across the continent. The first is agribusiness. So we invest across the entire agri value chain. And the rationale here is very simple. For you to have a productive labor force, they need to be well fed. And for any incremental development within an ecosystem, food security is critical, right? And then the second thematic area we look at is consumer products and services. Here we're looking at different diversified sectors across logistics, distribution, manufacturing, retail, and any supporting services. And then finally, we also look at enabling technologies. So technologies that are being used in a meaningful way to enhance operational efficiency in traditional sectors. And I guess for us, the thesis doesn't quite fit into venture capital and not yet private equity because we're not taking majority stakes into businesses. But if you think about the constitution of African economies, 70% of African economies are typically SMEs and micro SMEs. These institutions or organizations are typically either funded through family loans or bank financing. And they're often overlooked by traditional venture capital because they are perceived not to be scalable enough from a technology standpoint. A lot of these businesses are typically uh, being operated by one person or being operated by one person with a team behind them and offering a service as opposed to a product. And I think what's critical for us is to be able to support these companies to develop into the next stage. And that's why we shy away from the term venture capital and instead describe ourselves as an early stage investor that's focused on the sectors that I've just talked about.
I love it. And these three thematic areas you've mentioned are really spot on for Africa and what African SMEs need. So I like that you decided to go very unconventional. You're looking at agribusiness, you're looking at consumer and logistics, and also enabling tech. I want to find out from you. I came across one of your interviews where you talked about the M-Pesa mindset. You cited M-Pesa as a classic example of a technology-driven development that allows Africa to bypass traditional capital-intensive development stages. When you look at your core sectors that you've just mentioned, agribusiness, consumer and logistics, and enabling tech, what are some of the specific business models or founding team traits that would tell you personally that a company has the potential to create maybe a true leapfrogging impact, or is there just incremental growth?
Yeah. So I think we look at it from both an incremental growth perspective, but we also look at it when we think about the entire macros. We're thinking about the development cycles that could be potentially leapfrogged. Now, if you think about this rationally, development cycles can only be leapfrogged if, for example, in our context of the African continent, we have lagged behind fundamentally in a few basic services, right? But because technology has continued to develop across other parts of the world, should we allocate capital thoughtfully? It creates an opportunity for us to fundamentally move forward as opposed to having to go through the same experimental phases that a lot of other economies have gone through. And if you think about, for example, agriculture and agribusiness,
Yeah.
I think there's very limited mechanization across the continent. Farms and land are still being tilled by hand, by manual labor. And that's one natural way that you can automatically see that if you deploy capital in the right way, you can improve mechanization. And mechanization doesn't necessarily have to be uh, driven by fossil fuels, right? You could effectively leapfrog it by moving into alternative sources of energy to power mechanization. And that's the type of thinking that we like to apply in the investments that we do. When you think about even retail, when you think about how goods get to people, I think there's a lot of room to to effectively leapfrog the traditional development cycle. Another sector that I think is important to mention, and I think you've just talked about it with M-Pesa. I think M-Pesa was an initiative to essentially drive financial inclusion and give underserved individuals within the Kenyan market an access to a digital identity, right? So they can be able to transact and have a digital footprint with the idea that it will eventually create a credit profile for them. Now, if you think about African banking, it's still extremely traditional. Um, for me to send you money in Ghana, I think I don't even know how to send you money in Ghana. That's the
Tell me
first
about
problem,
it.
right? I don't know if you know how to send me money in Kenya. And I think when you have such very basic problems, it's very easy for you to create innovation around them and leapfrog potentially what has taken decades to do in other markets. So one thing that we're actively looking at the moment is stablecoins and their use case for cross-border payments. I think that's the first tangible use case we've seen within the crypto space that reduces friction across barriers and reduces cost. And if this technology is deployed, that's another way we can fundamentally leapfrog years of banking infrastructure that may not have been as developed as in other markets. So yeah, that's typically how we think about it.
I love it because we are exploring this really grassroots level, and it's making me really curious, Peter. Has there been instances where you have said yes to fund either a startup or an innovation that's, I would say, for lack of a better word, Western VC or P has said no to? What made you say yes, and how is that innovation doing?
Yeah, that's a very good question. So what we typically see, especially for non-tech enabled businesses, which we also deploy capital into, there's effectively a missing middle whereby you're either too small to be financed by a bank. By too small, I mean you don't have the asset base and collateral that a bank would require for you to receive funding. And then you're too small for private equity because they require you to be sizable enough for them to be able to deploy a significant investment. And then finally, for venture capital, because you're non-tech enabled, there's no belief in you being able to achieve a growth trajectory that can enable a closed-ended fund to be able to generate a return on their capital. Um, and that's what we typically do when we see a lot of businesses. So recently we've invested in a baking premix manufacturer that's based out of Kenya.
Okay.
Very traditional business, but the growth trajectory is similar to to a tech business, but it's overlooked because of the variables that I mentioned. They don't have a large enough collateral base. They don't have um, they don't have they don't have enough tech in the business to be able to justify a tech venture ticket, and they're too small for private equity. So our funding typically helps these companies grow, such that they can get into the next phase of growth where they're able to tap into those sources of capital, be it deploying technological infrastructure in their business if it has a useful use case, or it's helping them acquire the assets that can eventually unlock other forms of financing. And that's how we typically think about them. So in this case, this business has almost tripled in size since we began engaging with them 2 years ago,
Amazing.
and that's extremely impressive for a non-tech enabled business that's doing offering a very simple service. They're offering commercial bakeries premixes so that they can simplify their procurement and don't have to buy meat from one supplier, sugar, etc.
Wow. So Peter, this premix company you are talking about, I'm guessing you still had to do a certain level of due diligence, and maybe there might have been a bias, right, in your due diligence because you know I'm not going to go the traditional approach. I want to find out. Um, do you feel like it's upon you as an investor to address privilege in the VC space and in your role, especially leading due diligence? What's maybe one of those non-negotiable check and balance that invested world will insist on, right, to ensure that the local founder is not being subconsciously undervalued or being compared to a globally connected counterpart? How are you able to do that?
Yeah, that's a fantastic question because it's not an easy thing to do. But I think the first thing comes from you have to have a point of awareness in that there is a form of privilege when you are effectively deploying capital into a business and you can change the trajectory of a business or even a founder or a management team with that capital. So I think that's the first point. We have to remain aware. And awareness now forms the basis of approaching situations with a level of humility and empathy for the entrepreneurs that we're working with. And I think that's been the value that has shown through all our investments, the way we engage with entrepreneurs, the way we the way we source for deals, the way we conduct ourselves during due diligence. It all hails back to a point where we're thinking about fundamentally, we are custodians of capital and we are supposed to identify companies and entrepreneurs that um, just need a just need an opportunity to be able to grow their business. And a lot of times you find that uh, probably the less polished entrepreneurs, the less the entrepreneurs who are focusing less on their brands and more on their businesses, tend to have very fantastic skills in terms of operational acumen, in terms of being able to grow their business. So there's also a component where we find that we have to educate entrepreneurs to enable them to understand the type of capital that we're providing and what it can do for their businesses. So I think with respect to how we try to eliminate bias, I think our process is inclusive throughout. So there are different touch points with different members of our team, just to make sure that it's on only one viewpoint or perspective that is dominating our viewpoint or thought at any given point in time. And that's how we typically conduct our due diligence process. The multiple, yeah, the multiple checkpoints with different people on the team. Um, and yeah, we also try get third party assessments to make sure that there's something that we're not overlooking uh, that that could be fundamental in an investment decision. So hopefully that answers your question.
Yes, yes, it really does. And I want to press in a bit more on that. So, as much as you have systems checks in place, you're also trying to make sure that the everyday African business owner who does need funding but would otherwise be overlooked either because he doesn't have all these checklist items or because people are just not giving him the bandwidth, right? I invested by you. So, due diligence aside, for you, do you find that you have to make exceptions in some cases as well, either to fund either female entrepreneurs or the underrepresented? Because I'm thinking that you are curated towards the African startup. Are there places where you've had your checks and balances, but you said, you know what, for this particular case, let's let's waive an exception or let's go ahead anyway?
Yeah, that's a very good question. Um, I think first and foremost, our mandate, because we have taken on external capital from our limited partners, our mandate first and foremost is to back businesses that we believe we can generate a commercial return. For us, impact is typically a consequence of a good commercial outcome. And if you're thinking about what that means, I think the example that you mentioned earlier, M-Pesa, extremely inclusive product, but look at the fundamentals of it. It was, let's figure out how to make this work commercially. The impact of it has been outsized, and it's now trickling down into other parts of the continent. I think Momo is now taking off completely in West Africa. Even if you look at other banking services, I think a popular example in Kenya, Equity Bank, that focused on uh, traditional MSMEs as their customers who are completely overlooked. It's now, I think, the largest bank by assets in the Kenyan market. So if you identify a niche and you're solving a critical problem, fundamentally in this market where there's so many things to be solved, there's likely going to be a consequential impact from the operations, be it job creation, be it any tangible environmental or environmental impact. Yeah, so I think there's usually a fundamental output. Now, with your question to whether we make exceptions, I think one thing that we have to do when we're conducting these assessments is making sure that there's diversity within the teams that we back, right? Um,
Okay.
and it's important for us to engage with entrepreneurs just to make sure that they understand the importance of diversity within within the organization, because diversity of thought is what springs up innovation, right? It never comes from a point of consensus. A lot of times, the most brilliant innovations in the world have come through diversity. So we want to make sure that we're backing gender diversity. We want to make sure that we're backing, and we've made a commitment to the 2X challenge to make sure that we're backing female-led uh, opportunities as well. Um, yeah, so I'll stop there. I know I've rambled on a bit. But yeah, I'll stop there.
That's perfectly fine. Thank you for that, Peter. And um, if you're listening in, I'm talking with Peter Wamburu, who is the Vice President of Vested World. They are very non-traditional, unconventional investment firm in prioritizing societal impact and gender equity. We are having the conversation around the the responsible investor. And I'm very excited about the conversation we are having so far. So far, we've discussed how they have navigated going around the traditional VC and PE description to invest in maybe unconventional startups in Africa that's other traditional VCs wouldn't. And we're just talking about how he navigates the issue of bias in due diligence, and also how he's able to make sure that he's getting a wide diversity of startups that they invest in, startups and businesses that they invest in. Peter, I'd like to continue that conversation about just operationalizing equity, and then also maybe let's touch a little bit on data for funding. You've had a direct hand in improving Vested World's internal reporting. How can early stage African entrepreneurs improve their data tracking and communication to move them from to move their conversation from just traction to demonstrating operational mastery?
Yeah, that's a fantastic question. I think simply for organizations, especially when you're trying to balance multiple priorities, measure what matters. I think you focus on the things that fundamentally drive your business and you execute on them rigorously. A lot of times in early stage businesses, there's very limited bandwidth to focus on things that don't generate revenue or don't manage costs. And it's about figuring out what are the key things that drive your business. So maybe sometimes if you're a service-oriented business that needs to go out and acquire customers, it could be as simple as figuring out what your sales funnel looks like. If I visit 10 customers, how many of them will actually convert into revenue? And it's about analyzing your business from both a revenue, cost, and balance sheet perspective, and figuring out the things that really matter, and finding a way to implement systems to track them. I think at the earliest stages, the tools don't really matter. It matters more so that you're aware that these are things that are impacting your business. As you mature and have more resources to be able to deploy within the organization, I think you need to figure out how to deploy data analytics tools to be able to help you uh, track the things that truly matter. And that's what I want to emphasize in this conversation. I think that a lot of times we get caught up in vanity metrics, and then these can completely dissuade and even disorient a business because they start focusing on the wrong things that don't have a fundamental impact on their operations. So one, figure out what matters in your business across all the different areas that you're trying to move, be it revenue, be it cost, be it your assets, liabilities, etc. Um, and then find a way to monitor them. It could be simple at first. You don't necessarily need crazy technology. Could even be a book. Graduate to an Excel. Graduate to now finally a database. Graduate to now a business intelligence school. And I think that's the natural trajectory of things. But for most management teams, they need to understand the key things that matter, and uh, they're not usually a they're not usually an extensive list. It's usually a handful of things that are fundamental to the operations.
So track the things that truly matter. They might not even be a lot. They might be a handful. Peter, from our earlier conversations with other VCs that we've interviewed, we always ask what is the X factor that they look for, or what are the metrics that are important to them. So based on your reply just now, what are the things that you would look out for? If there are maybe 3 data metrics that you look out for to say, okay, I might be interested in investing in this startup, what would they be for you?
That's a very good question. So I think fundamentally, the first thing that you're looking for within any organization is the team, right? Because you can't really drive a business without people. Human capital is the make or break of any business. And you need to figure out whether you can work with a team. You need to figure out whether you're aligned in terms of your values. You need to figure out whether you're aligned in terms of your long-term outlook on a business. In terms of quantitative metrics that I think are critical for a business, I think one, capital efficiency. So you need to understand for every dollar that I put into a business, how much revenue or how much value can I generate, right? It's not usually an easy metric to measure, especially if you don't have any external capital that you've raised in the past. But you need to have a sense of if I take in $1 million or take in X, my output will be Y. And it's usually critical for a lot of businesses, especially in this market where there's not a lot of liquidity to support a business consistently raising capital. Two, I think the unit economics of a business is critical. So making sure that you understand your cost structure, making sure you understand how that will evolve, and making sure that you understand what are the levers that you can pull to manage your cost. So, for example, if you are in logistics and the price of fuel goes up, can you pass on that cost to customers, or you have to bear that brunt? And now figuring out will I have to make any additional operational adjustments in terms of the overhead. So I think being able to quantify your unit economics is extremely critical. The third thing, and I think this is the killer in most African businesses, is working capital. So understanding how long it takes you to convert revenue to cash is extremely critical. How quickly do your customers pay you? And when do you have to make your payments to your creditors and everyone who has supplied you with goods and services? I think it's extremely critical and to understand how your working capital cycle works. Because at the end of the day, when things get tough, you need to understand whether there's any leverage that you can take within your working capital cycle. So I'd say those three things. First, to sum it up, capital efficiency, second, unit economics, and then third, working capital. I think the other things that are important, obviously, like your growth rates, etc. But I think if you get those things right, you can be able to focus on other areas of your business.
Especially the working capital bit. I think you're really spot on with the fact that this is very unique to the African market. Thank you for that, Peter. So we've just looked at data, due diligence, risk assessment, and we've also looked at vested world and how you have positioned yourself in these three areas: agribusiness, consumer, and emerging tech. Peter, I'd like us to get a little personal now, maybe get to know you a bit. Can you explain the story of your personal journey? Maybe tell us a quick story about your personal journey, how you came into venture capital, and why Africa?
Yeah, that's a fantastic question. So I mean, I think my journey has been very unique. So I'm an engineer by training, a mechanical engineer by training. I started out working in hardware product development at one of the first startups in the Kenyan market. So we used to manufacture educational tablets for schools, and then they bundled them into into a kit, and then we used to send them into hard to reach areas. And I think that was the first time that I got exposure into how hard it is. You could have a fantastic product, but it's extremely hard to commercialize a product. Um, my next role after that was moving into renewable energy and supporting large-scale commercial firms and environmental organizations at a family-owned solar business. And yeah, I remember this is the first time that I saw firsthand the different, um, I'd say the different areas that the different levels that you have to put within a business. Sometimes you might have a lot of demand for your product or service, but you simply do not have the cash to be able to capture that demand. And you have to make very difficult decisions. And I was fortunate enough to work in that organization and see firsthand the way they would prioritize certain products, just purely because of its impact on the company's cash. Um, I'll caveat here by saying I always wanted to move into entrepreneurship, and I remember even as I had acquired my mechanical engineering degree, I was looking for a way to make a more tangible impact. So I got an opportunity to join an early stage micro lender. They were rolling out a buy now pay later product in Kenya. They were the first to do so. So I started out supporting and building the credit decisioning engine for the business, and also setting up the data infrastructure for the company. But my role now transitioned into strategy, analytics, fundraising, and that's when I got first-hand exposure into venture capital. I usually tell people life at a startup, especially a fast-growing startup. Um, if you've worked there for 1 year, I think you multiply it by three because you've done possibly everything that you can do within that business. I worked there for about 4 years. Within that period, the business had raised over
Wow.
$5 million of capital. And it's an accomplishment that I'm extremely proud of because I was directly involved in some of those fundraisers. And that's what gave me exposure into venture capital. So I decided to go do my master's. So I was awarded a Shivling scholarship, fortunately. So I went to do my master's in finance and technology at the University of Glasgow. Um, Fortunately or unfortunately, depending on how you look at it, I went during COVID. So I had a lot of free time on my, and because I had supported a business to raise capital, I started thinking through: is this a skill set that can be applied to other companies? So I worked with a few startups on an advisory basis and helped them secure their seed and seed funding to an organization called Parity. Then, as I was nearing the end of my time in the UK, I started reflecting on what I really wanted to do when I came back, because I was certain that I wanted to come back to Kenya. Um, and because long term I'd always wanted to be an entrepreneur, I realized that if I want to be an entrepreneur, I need to understand how capital allocation decisions are made. I've seen it from the other side of raising capital, but I wanted to experience it from a capital making decision, from a decision making perspective. So just before joining Versatile, I worked with a fund called Optimizer Foundation, focused on sub-Saharan Africa, helped them develop pipeline, and was also supporting one of their fintech companies with their data infrastructure. So worked with them for over the summer, and they pointed me in the direction of Versatile. And yeah, I've been at Versatile since beginning of 2022, so almost 4 years.
That's amazing. You've had quite the eventful journey, Peter, from selling solar powered devices all the way to finding your way in startup for over 4 years. And I love the transition, especially from early stage startup where you got your hands dirty to now being on the other side, which is Vested World. I want to find out. I know Vested World has a beautiful mission on your website, but for you, what was it about the mission that made you commit your energy there?
That's a very good question. Honestly, I think the first thing that drew me to Vested World was the people. After interacted with the leadership of the firm, I was convinced that this was the right place for me to make a move into venture capital and investment management. I think for us the thesis is Africans for the betterment of Africans, and that's what we're trying to
Mm,
do on a regular basis. Um, each and every day, I'm inspired by the humility that's across the team. I'm inspired by just the extreme intelligence and how careful the
mm,
team thinks about, and how carefully the team thinks about making investment decisions.
mm.
And that's what continues to inspire me about Vestival. I'm excited for the coming years.
I love it. I have personally met Eula from Vested World, so I definitely can identify with the quality of the team you have and also just their Afrocentric mindset, which brings me to this very probably controversial question. Do you feel like Africans are ready for seizing the opportunity that Africa itself presents, or do you feel like that is being capitalized on by non-Africans? I'll give you a good example. We spoke with Shehu Steve earlier, who mentioned that he doesn't think there's anything like an African VC or investor because number one, we just don't have the investors with that pool, or if we do, they're just not interested in startups and SMEs like Vested World is. So that means that there's probably opportunities for investing in Africa, but Africans themselves are not seizing it, are not seizing that opportunity. Based on what you've seen with Vested World, I just want your opinion. Do you feel like there are more Vested Worlds out there for Africa to leverage Africa and ideally help the continent?
Yeah, it's a good question. I think fundamentally, ecosystem building takes time. So the next generation of African fund managers are probably investment professionals at Africa focused funds as we speak. And I think because of currency volatility, because of just macros in developed markets, I think there's an increasing realization that we need local capital to back local businesses. Um, when you look at the African pensions industry and you look at where capital has been to, we're not even scratching the surface when you think about allocations into private equity and venture capital. And I think it naturally has to happen to be able to reduce our dependency on external capital. Already, there have been like ripple effects. I'm sure you felt them in Accra. There have been ripple effects from the closure of USAID, especially to a lot of African health budgets.
Mm-hmm.
And long term, obviously there's an immediate shock, but I think long term it's probably a net positive for the ecosystem because it forces us to find a way to fund these initiatives domestically. Um, and just to maybe close up, so I think what's going to likely happen is I think it's happened in Ghana. The more local fund managers in Ghana because the opportunity has been de-risked by vast loss capital from development finance institutions. And I think from the large ecosystem, so Ghana, Nigeria, North Africa, you're probably looking at Egypt, Morocco, you're looking at South Africa, and then you're probably looking at Kenya and East Africa. And I think in each of these territories or countries, you're likely going to see more drive from local asset managers into 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 alternative asset classes like venture capital and private equity. It only makes sense as we because right now most of the capital is going into real assets, so it's going into real assets and into government bonds. But I don't know how sustainable that is. So I think over time, as as a lot of these asset managers seek to diversify, you're going to have to see an increase in allocation into alternatives just to de-risk portfolios and to generate an additional return.
Well, we will be praying and fingers crossed that we get more investors who are looking to diversify. This was also the same sentiment from the earlier conversations that we've had. So it looks like we are either on the right track or we should get on the right track soon. Well, thank you, Peter. We've explored a bit of your mind and a bit of your background. Thank you for sharing that with us. Let's go back to Vested World and see some of your post-investment supports and value adds. I want to find out, has there been any startup that has surprised you, either positively or negatively, after you've invested in them, and why?
that's a tricky question because all our portfolio companies, I think from my perspective, like I think all our portfolio companies are fantastic. There's a lot of thinking that went into those investments, and we don't play favorite. I think we try to balance out our resources across the entire portfolio. With respect to whether there's one that surprised me, um, yeah, I struggle to answer that question because I think each of these companies that I have been involved in, each of the investments that I have led the diligence on, I mean, they fundamentally surprise you in one way or another. Either you were too optimistic, right, on how they would grow, and then life happens and you invest, or either you were too pessimistic and they knock it out of the park. Um, I think, yeah. So I find it hard to pinpoint a specific example because I don't want to play favorites within our portfolio.
Well, I appreciate your candor, Peter. I also want to find out, how does Vested World support your portfolio companies beyond just capital? So after you've invested in them, are there any other things that you contribute, like talent, partnerships, regulatory navigation, especially because we're in Africa?
Yeah. So we take board seats in about 70% of the companies that we invest in. And the immediate area that we try offer up support is just formalizing the company and establishing governance, which is extremely important if you're looking to raise foreign capital. It's always a good signal to later stage investors when a company has a well-formed governance structure. Um, We also have a technical assistance facility at the outbound company, and how it's deployed depends on the stage of the company and the priorities within an organization at any given point in time. So we've deployed this to support companies to um, formalize their accounting. So deploy ERPs systems across the entire business. We've deployed this to help them with recruiting key members of staff. One thing that we always see is as companies mature, they need more sophisticated uh, leaders across sales and finance. And we've been able to support some of our companies in recruiting senior leaders within those positions. I think the third thing that I'd say, because we are on the ground and actively developing relationships, we are always supporting our companies with respect to business development and with respect to helping them unlock additional capital, be it debt or equity in the future.
And has there been any time where there has been a conflict between you as the investor helping the startups go in a specific direction versus they choosing what they think is right? And it could be because you have a better eye view, but they are very obstinate in their way of doing things because, hey, this is also unique to their ecosystem. And how did you
Yeah,
resolve that, if I can find out?
I guess for us, the stance that we usually take is founding teams and management teams are the ones who are operating the business. They have more visibility into things that we will never have visibility into. Right? They may have more visibility into interpersonal relationships within the team, relationships with their suppliers, and relationships with their customers. The stance that we typically take is we want management teams to have the freedom to operate, operate their business how they see fit. And part of our diligence process is trying to figure out whether businesses are being operated ethically, whether they share the same values with respect to how they treat their staff, how they treat their customers, and how they treat their suppliers. And we'll try and make sure that we're holding them accountable to the things that uh, they've promised us during our due diligence process and as we're making the investment. But at the end of the day, the responsibility for operating is the management teams because we are a minority investor. In instances where we may not align on direction, I think conflict is a necessary part of any well-run organization. But I think what's even more
Mm,
important is a conflict resolution framework. And being able to respect each other's opinions is extremely important. But in most instances, the company is directly responsible for the direction that they take. We try to give strategic input,
mm,
and we try to offer up advice in any way that we can.
mm. Peter, you've been a delight to talk to. Thank you so much for your time. I've been speaking with Peter Wamburu. He's Vice President of Vested World. And Peter, before we sign off, I'd like for us to have a quick fire round, just lightning questions. First thing that comes to your mind. Are you ready?
It sounds good.
What's one book? Okay, so from your opinion, what's one book every African investor should read and why?
Wow. Uh, Range by David Epstein. I think it's a fantastic book. It talks about how
What's the
journalists
name?
triumph. Range by David Epstein.
Ray.
Yeah,
Mm,
let
mm.
me.
I have to get that myself. Okay. What's an undervalued sector in Africa today?
Oof. Uh, I think I think the creative economy space is very
Mm,
undervalued. And
mm,
my thinking here is if we believe that by 2050, 1 in 3 people across the world is going to be African,
mm,
it means there's a
mhm,
massively overlooked opportunity in terms of the content we
mm,
consume.
mm. I agree. And if you were not a VC, what would you be?
I'd be an entrepreneur. There's no question around it. I think VC, especially as you advance, becomes a entrepreneurship within VC. But yeah, I'd definitely be an entrepreneur.
Fantastic. Well, Peter, again, thank you so much for your time. We are signing off on the African Startup Capital. This has been Ammishaddai Ofori on the Innovator Spotlight Series. And I've had the delight of speaking with Peter Wamburu. He's Vice President of Vested World, a non-status quo type investment um, institution based here in Africa, investing in traditional and non-traditional SMEs. They focus on sustainability and gender equity. Peter, thank you so much. Is there anywhere we can find you and Vested World? And if someone wants to connect, how do they reach out?
Yeah, the easiest way to connect with me is via LinkedIn. Um, yeah, and please feel free to check out our website, vestedworld.com. Um, yeah, and then reach out if there's any way we could ever support, uh, either support or work together.
Fantastic. Thank you so much, Peter. This has really